Hi everyone and welcome to this new video. When you're looking for dividend stocks, the easiest mistake to make is ranking companies purely by yield. I hope you're not still doing that. A 7 or 8% dividend obviously looks more attractive than a 3% one, but sometimes that high yield exists precisely because the market is pricing in a problem with that stock or that company. So today we're doing the exact opposite. Instead of starting with yield, we applied 5 criteria simultaneously across the entire Canadian market to identify companies that genuinely stand out, not just the ones paying the most. So I hope this video will be helpful to you. My name is Rashid, I'm a CPA, and this video is of course for educational purposes only and does not constitute financial advice. Always do your own research before investing. So why yield alone isn't enough? So why you're not just let's just take the 10 highest yielding stocks or call it a day. Because a very high yield can hide a company in trouble or a dividend that's at risk of being cut. When stock's price drops sharply, its percentage yield goes up automatically, even if nothing good is happening inside the company. It's just simple mathematics. If the stock price goes down, that yield becomes all of a sudden higher and more attractive. That's why our analysis never stops at the number on the screen. We look at several angles at once to get much more complete picture. So our 5 screening criteria. Here are the 5 criteria we applied simultaneously. First, a dividend yield above 3%, which simply measures the income generated relative to the price paid for the stock. Second, a price to earning ratio or PE below 25. That's a valuation indicator, meaning that we avoid being overpaying for a stock. So it's basically telling us whether the stock's price is reasonable relative to the company's profit. Third, a return on equity, ROE above 10%, which measures how efficiently a company uses shareholder capital to generate profit. Fourth, a market cap above $2 billion to filter out small, fragile companies. And fifth, a 5-year performance above 30% to avoid situations where a high yield comes paired with years of ongoing value destruction. And it's worth saying clearly, a screener doesn't prove a stock is a good investment. It simply narrows our research universe down to a group of companies worth a closer look. So let's start with Bank of Nova Scotia, BNS. It's one of Canada's major banks, but what really sets apart it from its peers, its international footprint. Particularly in Latin America, it offers a yield of 3.61%. That international presence mainly functions as a diversification factor, setting it apart from other big Canadian banks that lean more heavily on the domestic market. That being said, the same exposure also brings risk, currency volatility, along with economic and political conditions specific to those markets. Bottom line, a classic Canadian bank, but with a geographic profile that looks different from its peers. Next on our list is the Canadian Natural Resources, or CNQ. It's an oil and gas producer, so we're in the energy here, and I will come back to that a bit later because there are several energy names in this list, and they don't all work the same way, obviously. CNQ combines a yield of 3.63%, a price to earning ratio of 14.4, and a historical 5-year return of over 200%. But this past figure, which obviously doesn't tell us what the stock will be doing, will be going forward, its real competitive edge, its cost structure, recognized as one of the most efficient in the industry. The main risk with CNQ is that it remains directly exposed to swings in oil and gas prices. Bottom line, a cost structure that stands out in its sector, but a dependence on commodities that. Next, we have Sun Life. It's a life insurance and wealth management company. So we're stepping outside of the traditional banking sector that we saw with BNS. Sun Life offers a yield of 3.16%. What really stands out is its presence in Asia, which acts as a source of diversification and a potential growth lever on top of its insurance and asset management operations in Canada and in the US. The risk to watch is tied to financial markets broadly, but in a more diversified way than a bank. since its business spans multiple lines and multiple regions. Bottom line, a way to diversify your financial sector exposure with growth lever in Asia. Next is Pembina Pipeline. Here's our second energy name, but with a completely different model from C&Q. Pembina isn't an oil and gas producer. It's an infrastructure company that transports and processes oil and gas for other businesses. It offers yield of 4.18%. Its model is what's called fee-based, meaning it relies on a fixed fees and long-term contracts rather than commodity prices themselves. That generally makes its revenue more predictable and less directly sensitive to day-to-day swings in oil and gas prices. That being said, that doesn't mean it's fully insulated from energy cycles, just that it's exposed to them differently than a direct producer. Bottom line, energy exposure, but with structurally steadier revenue than a traditional producer. So that's for Pembina Pipeline. SOBO is the next one. SOBO also belongs to the transportation side of energy rather than production. It was spun off from TC Energy Liquids transportation business, and it owns the well-known Keystone pipeline system. It offers the highest yield among our top picks at 5.36%. Its strength is that its infrastructure is hard and expensive to replicate, and a good portion of its revenue comes from long-term contracts. So that said, as a standalone entity, its track record is relatively short, which means less history to judge its consistency over time. On the risk side, it's also worth watching its debt level, pipeline safety and maintenance, and all the regulatory and environment risks that comes with this kind of infrastructure. So bottom line for SOBO, Southbow, is hard to replicate assets, concentrated revenue, but still a short track record as an independent company. Number 6 is Peyto, P-E-Y. Now here's Peyto, and this is where the distinction between energy companies really matters. Unlike C&Q, which is diversified across different type of oil and gas, Peyto is almost exclusively a natural gas producer, so it's much more directly exposed to swings in the price of gas. It offers a yield of 5.21%, a PE ratio of 11, and the best historical 5-year return in our entire selection, a roughly 260% price performance in the past 5 years. And I want to stress the word historical here. That performance belongs to the past, and it doesn't tell us anything about the stock's future potential. What really stands out, it's operation discipline, cost control, well recognized in the industry, but its risk is exactly that heavy exposure to natural gas prices, which means more volatility than the other energy names we've covered so far. Bottom line, Peyto is the best historical performance in this selection, but also the greatest sensitivity to gas prices. Number 7 is Freehold Royalties. It's yet another model and probably the most unique energy name on this list. It isn't a producer, it's a royalty company. So in other words, it collects a percentage of the production other companies generate on its land without having to operate the well itself. That's much less capital incentive model than a traditional producer. Separately from that, its current yield sits at 6.31%, the highest in our entire selection of 8 stocks. Its revenue still remains sensitive to oil and gas, as well as to the investment decision of the producers operating on its land. If those producers slow down their activity, Freehold Royalties FRU will feel the impact. Bottom line, a lighter capital efficient model with the highest yield in the selection, but again, an exposure to energy cycles that's very real. Next, Northwest Company, NWC. We wrap up our tour with this company, the only retail name on this list. It operates essential stores in remote communities where competition and logistical barriers are significant. It offers a yield of 3.23%. Its competitive edge comes from those very same logistical constraints. In many of its markets, they make it difficult for new competitors to move in, which prospects its position. On the risk side, we're mainly talking about high logistics costs because they are located in remote areas, significant transportation costs, food inflation, and the challenge that comes with supply in remote markets. Bottom line, a defensive holding protected by the same logistical barriers that also represents its biggest challenge. Now that we have gone through all the 8 companies here, how I would rank them from the strongest to weakest based on my preference and analysis. And I want to be very clear, this ranking is subjective. It's not a list to follow to the letter. It's definitely not a buy this, avoid that list. So in the first place, CNQ for the best balance of low costs, diversification, and valuation. Then the bank BNS for Canadian banking solidity, plus international diversification. Then PPL among the most Pembina pipeline, among the most predictable contract-based revenue in the energy sector. In the fourth place, Sun Life Financial, SLF, for its diversification with growth lever in Asia. Then Northwest Company, a defensive holding with unique pricing power. Then FRU with high yield, but a lean model worth watching closely. Then SOBO, SOBO, with hard to replicate assets, but a short track record as a standalone company. And finally, in the eighth place, one of the most volatile, Peyto shows the best historical 5-year performance in the entire selection, but it lands lower in my ranking because of its greater exposure to natural gas cycles and volatility. And I will say again, this ranking is subjective, and landing in 8th place absolutely doesn't mean it's a bad company, obviously. Risks worth remembering. Before we wrap up, let's talk about risk. Because no dividend is ever guaranteed, a company can reduce or eliminate its dividend overnight for its situation deteriorates. If the situation deteriorates for the business, the Canadian market is also heavily concentrated in financial and energy, which means these 8 companies taken together don't automatically form a diversified portfolio just because it's 8 different name. There's also the commodity price exposure, interest rate sensitivity for bank and Sun Life, and valuation risk, obviously. I will say this one more time, a high yield can sometimes be a warning sign rather than a bargain, not a guarantee for a better return in the future. So to sum up, the core message of this video is dividend yield is only a starting point, never a conclusion. Our screener combined income, valuation, super important valuation. The income component obviously is also important for passive income investors. Company size adds a level of protection and historical performance, but individual qualitative analysis is always still necessary before investing. Try to know more about those businesses before you decide to embark. Tell me in the comments which of these 8 companies you find most interesting to dig into further and why. And you will find the full article with all the details linked in my blog. I will put the link in the description. If you're interested to build in a portfolio using ETF, I do also have model portfolios available in my blog. I will put the link in down. So thank you so much for watching the video till the end. If you like the content, please subscribe and like. Thanks.